Right now, three of the most powerful software companies on the planet are being treated like they're already dead. Wall Street has written them off. Retail investors are panic selling, and the headlines are absolutely brutal. But here at Smart Market Signal, when everybody hates something, and I mean everybody, that is exactly when the smart money starts paying attention, not blindly buying, but paying attention. And that difference right there could be worth tens of thousands of dollars to you over the next decade. So stay with me, because what I'm about to break down in the next few minutes could seriously change the way you look at these three stocks forever. And if you're new here, hit that subscribe button right now, because we do this kind of deep work every single week and you do not want to miss it. It takes 2 seconds and it genuinely helps us reach more people who need to hear this. Let's start with TurboTax and QuickBooks. If you've ever filed your own taxes or run a small business, you've probably used one of these products. Here's the situation. The stock is down nearly 50% from its all-time high. It was trading at over $800 a share, and now it's sitting around $400. Year to date, it's down 35%, and in the last 6 months alone, it's down 40%. That is a brutal sell-off, and the reason Wall Street gives us is that artificial intelligence is coming to eat their lunch. The fear is that AI tools are going to replace TurboTax and QuickBooks and make the whole business model obsolete overnight. And when that fear spreads, investors sell. And when they sell fast, and it feeds off itself. But here's where it gets really interesting. The business is still growing. They are still generating serious cash. Last year, Intuit ticker INTU did $6.8 billion in free cash flow. Their 5-year average was for $0.8 billion. That means in less than 2 years of this year's free cash flow alone, they could wipe out their entire debt. Let that sink in. Right now, the exact same stock, which used to trade at 40 to 50 times free cash flow, is now sitting at just 16 times free cash flow. That is a massive compression in valuation. And, historically, that kind of compression in a business still growing at double digits is where the long-term money gets made. Their price-to-sales ratio is 5.6, while Microsoft, for comparison, trades at 10 times sales. You are getting Intuit at basically half the price-to-sales of Microsoft. They are not the same company, but they are both software businesses with incredible margins. Now, is the AI fear valid? 100% it's valid. AI is going to change things. Nobody is disputing that. But the real question is whether the business has already fallen apart to a level that justifies this kind of price destruction. And the answer right now is no. Revenue grew 17% last quarter, and they are guiding for around 10% this quarter. Slower, yes, but not falling off a cliff. And here's the real thing about QuickBooks specifically. The estimates show QuickBooks owns roughly 85% of the small business accounting market in the United States. Switching accounting software is annoying. It's disruptive, and most businesses simply won't do it unless there's a massive reason to. Once your invoices, your customers, your entire financial history is inside QuickBooks, you don't just leave because a new AI tool showed up. The switching cost is a moat, a real moat. Looking at Intuit MailChimp does concern me. They used to own 70% of the email marketing market, and they are now down to the low 50s. That's a real issue, but that's one product line inside a much bigger machine. When I ran the numbers with conservative assumptions, 5, 8, and 11% revenue growth over 10 years, I got a low price of $400, a middle price of $600, and a high price of $890. The stock is sitting right at the bottom of that range right now, and that tells me there is a real conversation to be had here. Now, let's talk about Salesforce, ticker symbol CRM. You may not use it yourself, but if you have ever gotten a sales call from a major company or received a marketing email from a business, there's a very good chance Salesforce was running everything behind the scenes. They are the backbone of how corporations manage their customers, and the stock is down over 28% in the last 6 months. This is the same story as Intuit, where AI fear is hammering the valuation. The thinking is that AI agents are going to replace Salesforce seats entirely. Why pay for the platform if an AI can just do the job? Wall Street is pricing that fear very aggressively right now. But look at what the numbers actually say. Free cash flow last year was $14.5 billion. Their 5-year average was $9.6 billion. Net income over the last 5 years averaged $3.9 billion, less than a third of the free cash flow. This is why you have to look at free cash flow. Net income is easier to manipulate. Free cash flow is real money hitting the business, and that's why the price-to-free cash flow ratio of 12.3 looks wildly different from the price-earning multiple of 24. Free cash flow 12.3 for a business that has grown revenue at 20% a year for the last decade. The 10-year revenue growth is 20%, and the 5-year is 14%. And margins are improving. Last year's net profit margin was 18% compared to a 5-year average of 11%. The business is getting more profitable even as Wall Street panics. Analysts are projecting earnings per share to go from roughly $12 to over $21 in the next 5 years. That's nearly an 80% increase in profit in 5 years with the percent revenue growth. And Salesforce isn't sitting still either. They're building their own AI platform called Agentforce. They're betting that AI makes them more valuable, not less. Whether that plays out is the big question, but they have the resources, the customer base, and the moat to make it work. When I ran the analysis with conservative assumptions, the middle price came out around $320. The stock is sitting well below that at a price-to-free cash flow of 12.3. This is the cheapest Salesforce share price has been in years. And this brings us to stock number 3. And honestly, this one might be the most compelling setup of all 3. ServiceNow, ticker NOW. And this one is a little different because if Salesforce felt sticky, ServiceNow is the stickiest of the 3 by a mile. Here's what ServiceNow actually does. They help massive organizations, hospitals, banks, governments, Fortune 500 corporations manage all of their internal operations, including IT tickets, HR workflows, legal requests. Everything flows through ServiceNow. This is not a consumer product. Regular people will never use it. But the companies that do use it are locked in so deeply, it's almost impossible to leave. These systems are wired into the entire nervous system of an organization. You don't rip that out over a weekend. You don't rip it out because a new AI tool showed up. The switching costs are enormous, and that is what makes this business different from almost everything else in the software space. The stock is down over 30% this year and over 50% from its highs. And yes, the AI fear is the same story again. AI agents will replace the platform. Why pay for ServiceNow seats when the AI handles it? The valuation was stretched going in. So when the fear hit, the selling got brutal. Looking past the noise, we can see revenue has grown at 30% a year for the last 10 years, and 30% compounding for a decade. The 5-year average is 24%. And the 3-year average is 22%. And the acquisitions that drove that growth was only $2.35 billion over 5 years total. Meanwhile, they averaged $2.9 billion a year in free cash flow over that same period. That means they essentially funded all of their growth out of organic cash generation. That is an incredibly capital-efficient business. Free cash flow last year was $4.5 billion. Enterprise value is $111 billion, which is roughly 23 times free cash flow. This is a recent business analyst's projection that its revenue will double in the next 4 years. Now, I don't model that level of growth myself. I'm conservative. I ran it at 9, 13, and 17% revenue growth with free cash flow margins between 30 to 36%. Even with those lower assumptions, my middle price came out at around $160. The current price is not far from that. The margin of safety here depends entirely on how much you believe AI genuinely disrupts this category. And when you think about how embedded ServiceNow is inside billion-dollar organizations, the disruption thesis is a lot harder to execute than the headlines suggest. Here's the honest truth about all 3 of these names. This is not me telling you to go buy Intuit, Salesforce, or ServiceNow today. That is not how smart investing works. What I am telling you is that these three businesses are being treated by the market as if AI has already destroyed them. And the financial reality does not support that conclusion. Not yet. Maybe never. The real work now is asking the right questions. Is the AI disruption real and permanent? Or is the fear creating a temporary overreaction in price? Historically, the best entry points in great businesses come when the narrative is the most negative and the price reflects maximum fear. That is exactly the setup all three of these stocks present right now. Whether you act on that or not comes down to your own research, your own risk tolerance, and your own conviction in the numbers. If this video gave you a different angle on these three stocks than what you've been hearing elsewhere, drop a comment below and let me know which one you think has the most interesting setup: Intuit, Salesforce, or ServiceNow. I read every single comment and I genuinely want to know what you think. And if you found value in this breakdown, share it with one person in your life who's been watching their portfolio get hammered and doesn't know what to make of these names. That share costs you nothing and it means everything to this channel. Hit that like button, subscribe if you haven't already. But if you believe software stocks aren't dead yet, this makes it a great way to get rich without getting lucky. And if you want to see what else I'm buying to get rich without getting lucky, consider checking out my next video. Thanks for watching, and until next time, this is the X-Invest Hunter. My name is Martine, reminding you that the best investment you can make is in you and that you only need to be right one time to change your life.